Hey guys, welcome back to another YouTube video. So for today's video, we're going to be talking about insurance, essentially what is insurance in a simplified way and the factors and the kind of ways we could leverage it. It's really important. So if you are using insurance, you don't understand that this is for you. If you know anyone that's under 18 years old, send this to them right now. So yeah. Now, I would like to start off by getting a misconception out of the way, okay? Insurance is not just for old people who are about to pass away and are trying to leave something for their families. We first need to understand, who does insurance help? And the answer that many people don't really know is that insurance is for individuals and businesses as well, okay? Now, there are many different things within like the two Venn diagrams, but when you look in the middle, both parties, should I say, they want financial security. They want to be financially secure. They want to know that, the money or their assets are in safe hands. And if anything happens, which this life is full of things that happen, are protected. And so that's like the main idea between how it can help individuals and businesses. And as you watch my beautiful drawings, I just want to share that some of the things I'm going to go over this video is how to identify basic insurance concepts and principles, along with distinguishing between like the different kind of risks, losses, pearls, not pearls, but like PERILS, and hazards, along with recognizing the difference with the different type of insurer structures and functions, because there are quite a few and it can get confusing. And then we're going to talk about identifying the methods of managing risk and elements of insurable risk. And as you can see in the bottom, I'm just putting this note to help us better understand what insurance is and overall just their goal. I like to state that the goal of insurance is to provide a way to manage uncertainty, because this life is full of it, but also to reduce the impact of potential financial loss. And I think two things that I want to bring about is that, we need to really understand the elements and the different kind of characteristics of legal insurance contracts. Sorry that I was writing off the page. I did not notice that. But yeah, in this video, we're going to go over all that and the different kind of methods for managing different risk elements of insurable risks, and then the different types of insurers and their structure, along with distinctions between what is a risk, what is a loss, what is a pearl, which is going to be really important further in the video. So now I just kind of want to talk about what insurance is in a nutshell. Essentially, insurance is a financial safety net that helps people when unexpected events happen in life. And it also protects individuals and families from financial hardship. So, for example, if your home was flooded, you would want home insurance to alleviate some of that financial hardship with trying to repair your home. And so the bullet point that I'm putting at top is just that a financial tool is insurance, which is designed to protect individuals from uncertainty in the future. And again, uncertainty is bound to happen. This life is not perfect. And so when someone buys an insurance policy, they have to pay a set amount. Now, this is called a premium. That's what I've highlighted in red. And they pay it to the insurance company. Now, in return, the company takes on the financial risk of something unexpected that may happen. That could be that home that has been flooded. Now, I draw this little circle that goes around, and I call it the life cycle of risk. Essentially, it's just a display of a risk transfer. This is the best way I could illustrate it. And a risk transfer just helps the consumer protect their finances, along with the reducing of like the anxiety that people could be facing about the unexpected events. Now let's go in for a short quiz. Now let's understand risk and the different kinds of risk. So first, risk is the chance that something bad could happen, leading to financial loss. Simply to put it, it's the uncertainty of a potential loss. Insurance exists to help manage that risk by providing financial protection when unexpected events occur. Now I'm going to break this down into two different types of risk in the table you see. So the first type I want to talk about is pure risk. This is essentially when it results in either a loss or no change in status. So there is no possible gain. And a good example for this is like if a home was destroyed in a fire. That is a pure risk. There is no kind of gain from that event. Now, there's also a speculative risk, which is the one on the bottom, and this results in a gain, loss, or no change in status. And a good one is like investing in the stock market. Now, you really need to understand that insurance is designed to protect against pure risk. So speculative risk, like investing in the stock market, will not be covered. And because they only protect against pure risk, it can only make up for a loss. So if there is a potential gain, insurance will not provide benefits for that. Now I want to talk about three things. One is a loss, exposure, and perils. Now, a loss is essentially the reduction or decrease or disappearance in a value. And then an exposure is being at risk of a loss, if that makes sense. So, like, even if nothing happens, that's still an exposure. And then a perils is the actual cause of a loss. And I'll better explain these and give better examples further ahead. Now let's talk about hazards and the different kind of hazards that are out there. So a hazard is a condition that makes a loss more likely to happen. It essentially increases the chance that a peril, again, a peril is the actual thing, so for example like a fire, theft, or injury, will cause damage or financial harm. Now there are three types of hazards. There's a physical hazard, there's a moral hazard, and there is a moral hazard, and each are affecting risk differently, and I'm just gonna show you and describe them below. So for the physical hazard, this can be like a tangible condition that makes a loss more likely. For example, it's been snowing for the past couple of days, so essentially ice on the sidewalk. That is a physical hazard. Next, a moral hazard could be an intentional dishonest action that increases the chance of a loss. So for example, someone purposefully setting a home on fire, trying to collect insurance money. And then a moral hazard is careless behavior and an attitude of indifference that risk could increase. So not wanting to use your seatbelt, or driving or leaving your car unlocked are good examples of a moral hazard. Now let's go over some key takeaways I want you to remember, okay? Insurance helps manage financial uncertainty by transferring risk of loss to an insurer. Think of that risk transfer cycle I talked about earlier. Additionally, risk is the uncertainty or chance of financial loss. And there are two types of risk. Again, there are pure risks, which only has a potential outcome of a loss or no change with no possible gain, because insurance exclusively covers for pure risk, like a home being on fire or disability and death. And then there's a speculative risk, which can result in gain, loss, or no change. And speculative risk are things such as investing in the stock market or gambling, all things that are not insured. So a loss is any reduction, decrease, or disappearance of value that impacts the financial well-being simply by being exposed to potential loss or anything that creates risk. And then a peril is the cause of a loss. A hazard is any factor or condition that increases the chance of severity of a peril. And there is a physical hazard, moral hazard, and a moral hazard. Some good examples to further along are like, damage electrical wiring. What is that? A physical hazard. Deliberately causing damage to someone's car for insurance money. That's a moral hazard. Another good one is leaving your home door open, saying no one's going to come in. That's a moral hazard. So those are some good examples. Next, I'm going to be talking about insurable risks. Now, insurance companies carefully manage risk to maintain financial stability while providing coverage to policyholders. And they have to alleviate risk based on statistical data, and they have to group them based on insurability and use various strategies to balance high and low risk groups. Now, I'm going to talk in this section about how to manage those risks, or better, how they make the risk insurable and what are some risks that are excluded, and how insurance protects themselves from these excessive losses. And I think understanding these principles will better explain and help us understand how and why insurance works the way it does and why premiums vary between different policyholders. The best method to understand this is the STAR method. So the STAR method stands for sharing, transfer, avoidance, reduction, and retention. For sharing, it's essentially just risk transfer, so like spreading the financial burden to potential loss. And then for transfer, it is just the risk transfer, shifting the responsibility to another party. And then for avoidance, it is eliminating the exposure by choosing not to engage in high risk activities. Then for reduction, it is just risk reduction, which is minimizing the likelihood. And then for retention, it means accepting responsibility for a potential loss rather than transferring it. Now let's look at some risk insurable things. That could be the loss is predictable, it's accidental or uncertain, it can be measurable, it can create financial hardship. Keep in mind this does not include war. So, in the case of that kind of event, insurance companies will not be able to cover it since it's so catastrophic. And then when there are a large number of homogeneous units that must be exposed to the same risk. Now let's go in for a quiz. Now, if you're like me, you love to think about the edge cases. So why do we have auto insurance and why do we not have skateboard insurance? Well, let's look at the different factors that insurance companies have to take into play. There are millions of drivers, but there are also millions of skaters. Well, we can track the number of people, the age, the driver history, and the vehicle type to see and assess risk. But for skateboards, we don't have that information in terms of the injuries that come about. And so because they don't usually result in high financial loss, the risk isn't substantial enough for insurance companies to keep count and cover. And this kind of brings me to the law of large numbers. This law shows us how insurances predict losses. When they have files of history about people with the same problem that you're going through, they know the kind of loss they could be facing when they're dealing with you. Now let's talk about adverse selection, essentially when risk is not spreadable. If you have two individuals, one is 19 years old with 100 car accidents, and then one is 30 years old with 0 car accidents, the insurer may charge higher premiums to the person who is riskier, such as the 19-year-old with 100 car accidents. And this could even lead to a decline of coverage in extreme cases. And so it's really important to understand that there are a multitude of factors that go about your insurance. And it's really important to talk to someone who's familiar with that to see how you can best get more coverage or better coverage. And now let's talk about reinsurance. Now this is something really interesting that I learned. So essentially it's insurance for insurance. I know that sounds crazy, but insurance companies protect their financial stability through reinsurance, which is essentially transferring. And they're transferring some of their risk to another insurer. So I like to think about this as like a path. If you know me, I love displays that helps me really understand. And so think about it as like the primary insurer, which is called the ceding insurer. It cedes to the reinsurer, and that ceding is just giving away part of that risk. You can think of it as like a river. It's parting some of that risk to the insurer, therefore reducing their final exposure. And there are two kinds of reinsurance. So there's a treaty reinsurer, which is it automatically cedes, and then there's a facultative reinsurer which negotiates that coverage. Now, here are some final key takeaways you should walk away with. Number 1, managing risk. What is risk? How is it managed? And if you want to look back into the video, it's when I'm talking about the STAR method. So that is a great point to go back to. And then what are the characteristics of insurable risks? That is also really important to identify what are the factors that they're taking in and how that can be changed. And then look back to the law of large numbers. That is really important. And then look at adverse selection, reinsurance, the two different kinds of reinsurance we have. There's one that is treaty reinsurance, which is automatic, and then there's a facultative reinsurance, which is, negotiated. All these concepts show how insurers assess and manage risk effectively to determine insurability and maintain insurance affordability and availability. Thank you so much for watching this video. Leave any comments down below if you have a question. I will sure to check and make sure I respond to everyone. I love you guys. Thank you so much for supporting and watching my videos. Stay tuned for another video. Until next time.